Good morning, traders. This is your Forex market commentary brought to you by ECN. In line with today's discussion, we will touch base on the euro-dollar market. This commentary will attempt to explore the euro-dollar pair on both the fundamental and technical fronts. I hope that this commentary will prove to be insightful for you in formulating a successful trading strategy. First, in line with this commentary, we'll touch base on the euro-dollar pair on an hourly time interval on the technical front. An impressive week for the euro-dollar market so far, as today's trading session will mark the fourth consecutive gain for the euro against the greenback this week. An overview of this week's trading session for the euro-dollar pair showed that the euro began this week's trading session rallying from last week's bottom set at 1.3700 on an upbeat German industrial production print. On Tuesday, the pair finally gathered sufficient momentum to break out from the 200-day simple moving average, and this rally was later reinforced by Wednesday dovish rhetorical from Fed's official. The shift in fundamental outlook on the greenback had enabled the euro-dollar cross to break out from the 1.3800 mark and struck off an upbeat US initial jobless claim print by rallying to the 1.3885 zone. This bullish momentum is also supported on the RSI. Currently, the pair are trading above the 55.00 price value on the RSI, which is indicative of a strong bullish bias on the current price action. Retail investors have been attempting to predict a top in this bull rally by increasing their net positions. According to the SSI, which is also known as the Speculative Sentiment Index, retail net euro positions have rose from 3 to 4 outstanding shorts for every one long euro position taken by against the greenback. However, retail sentiment towards the euro is nowhere near extreme at net 8 outstanding short position back when the euro-dollar market topped out at 1.3900 level. Therefore, analysts are suggesting taking a contrarian standpoint on the sentiment, which entails further strengthening of the euro. Since the euro-dollar pair broke out from the resistance level at 1.3820, the next target is set at 1.3900, followed by 1.3940 level. Analysis of a collection of technical indicators on the hourly interval on the euro-dollar market suggests a temporary bullish market sentiment and recommend long positions on the euro. The hourly chart showed that the single currency opened today's Sydney trading session inching closer to its established short-term Fibonacci support at 1.3879, while the Fibonacci resistance is set at 1.3893. This week, euro bullish rally allowed the euro-dollar cross to break out from the 200-day simple moving average and continue to trade above the 200 days. Therefore, the long-term outlook on the single currency had been upgraded to bullish if this trend line continued to trade above the 200 days. This trend action holds great significance as 200-day simple moving average contain more or less of 1 year's worth of trading data, and it forecasts long-term market sentiment. The bullish long-term outlook on the euro-dollar pair is also shared by its short-term moving average counterpart, as the euro-dollar pair opened today's Sydney trading session below the 5 but above the 10, 20 and 30-day simple moving average. Collectively, this is indicative of a buy recommendation on the technical front. Now, moving on to the fundamental front on the euro-dollar market, despite an early sign of an improvement in the US labor market with initial jobless claim beating expectation by coming in at 300K, when the forecast was set at 320K, the euro-dollar market continued to buy into the dollar weakness. This bearish greenback sentiment began last week when the US non-farm payroll print missed expectation despite an improvement in weather for the month of March. Therefore, investors are becoming concerned about the fundamental health of the US labor market. In addition to that, Wednesday FOMC minutes release indicates that the Fed officials are more dovish than what the market has anticipated, and they reiterate to the market that the market has overpriced the expectation of interest rate hike ahead of what the Fed is comfortable to do. These wildcard comments have questioned the fundamental structure of interest rate expectation that the market has priced in. Since the market detests uncertainty, it gives investors very little reason to hold long US dollar positions. The remaining risk event for this week are the US PPI month-on-month expected to tick at 1.1%, as well as the University of Michigan Consumer Survey for the month of April. This week's trading session has proven to be a quiet week with regard to the Eurozone economic releases. However, this did really little to stop the euro from rallying on 4 consecutive days against the greenback on the broader greenback weakness. It is important to note that the Eurozone and the ECB has not changed their dovish standpoint on monetary policy. The current prevailing theme is that Mario Draghi continued to explore options of aggressive easing measures such as negative interest rate and introducing another quantitative easing program to combat deflation. A disappointing French CPI number month-on-month tick at 0.5% when forecasts expected to come in at 0.6% highlights this deflationary pressure that the ECB are trying to address. Also, the Germans are expecting to release their CPI print month-on-month forecast at 0.3% on Friday. I want to thank all our listeners for spending their time with us, and until then, have a great weekend, everybody.